Welcome to episode 245 of The Numbers Game. It's Jason, Nick and Marty. Marty, how are you, mate?
I'm going well, Jace. I've been pumped up. I've been out on the road engaging with people and business owners and investors, and I feel alive. It's funny how that face-to-face stuff, you really learn things off people that you can only assume when you're hiding behind the laptop or, sitting in socials. And it's one thing that I just encourage every salesperson, every business owner to do, because you learn so much for when you're in the when you're face to face in the trenches of battle. So, and today I wanted to talk about, and it was inspired by something Nick said in a previous episode about understanding the cost of one of the financial planning products. What if your largest client was costing you money? And the reason I bring up that episode is because there was an investor on an advisory board that I had the privilege of listening to, and I was just asking questions because, again, my knowledge is up to a certain point, and I'm always interested to see what people are doing that have done much more than me. I think that's sometimes the best learning. And I picked up sort of 4 powerful lessons. Some we would have heard before, but there were others that I thought were pretty powerful, and I just hadn't thought about it in that way, even though we could probably break it down to how we know it. But so again, quality, profit, exit, interesting things that investors are thinking about when buying businesses that sometimes the founder wouldn't recognize themselves when they're in the trenches of business. And lesson 1 was tracking profit per hour, not just revenue. So I thought that was interesting as to why, but we've all been taught to chase revenue, and it's it's a metric we all know, and we look at overall profitability. But when you're looking at profit per hour, it's sort of optimizing the efficiency around revenue. So what they're looking at is to say, if you've got a client that's generating revenue of 100,000, but you're having to input massive amount of resources behind it, a lot of time around team. It's taking you 50 hours to get to that result, and you're ending up with 20 grand net profit on the back end of it. That's not as optimal as a client that might be generating 30,000, creating a 15 grand profit that's taking a fifth of the time. And my question was, all right, I sort of once it was explained, I sort of got where he was coming from, but I said, why do you think in that way? And he said, well, as an investor, I'm looking at sort of a 4 to 5 year time frame on getting return on my money. So it's really important that the business is efficient per client so we can scale it. And he said the other thing business owners tend to do is they get stuck in like huge timeframes in getting their revenues. And the line is, if you can jump over a 30 centimetre fence or a 6 metre high fence and you're going to get the same reward, why wouldn't you jump over the 30 centimetre fence? Like sometimes through complexity, we make things harder in order because it looks good, or we might have a bigger ticket on the top end, but sometimes we can have simplicity, in order to get to a result a lot faster that's more efficient, that we can scale. And also there's less complexity around the operations to deliver it. So it's not affecting the quality. You want the quality to be really good in it. But it was just a perspective shift that I thought, yeah, okay, why would you do something harder when you can get a better result? And timing the profit per hour per client was actually interesting. I don't know, you've probably heard about it before, but I just hadn't heard it presented in that way and why that was important, from an investor's standpoint. So, Jace?
No, I absolutely love it. And we're coming into that time of year where we start to review, where we've come from over the journey of the last couple of years, how we've adapted our services, our products, our mix of what we sell to make the ideal client. And then as we head into a new financial year, we also then try to define who is our ideal client. Now, these numbers are triggering because we've had the 100K client before, and the stress, the pressure, how many team members need to be involved, what the deliverables are, how many entities there are, what are the things we missed that we needed to be across that we then have to go back and catch up on. What's the extra senior person on a bigger salary that needs to be across that particular client portfolio versus the 10 or 20 grand client or the $30,000 client in this example, how much simpler that can be to run. You know, the less experienced team member that may not be on as big a salary who can do the bulk of the heavy lifting. Like, it is actually a really interesting way to look at it. It's something we've done it at a bigger, more macro level, but I'm now interested off the back of that, Marty, to kind of cherry pick a few clients that I think are really well looked after, but you know, there's a good value exchange in what we earn and what the client pays and everyone's happy. I'd be interested to unpack whether they're the profitable clients that I envision that they are versus actually knowing the numbers the same way you've just unpacked it.
No doubt there's a sweet spot, isn't there? There's when you hear it, you go, oh, I wonder what that sweet spot is. And where, look, I think about, Nick, even in regards to, I mean, mortgage lending is the core of our business, so it's important. But I think about some of that cash flow lending where you get that, you get that turnaround in 48 hours instead of 4 months to payment, and yet it's just as valuable to the client. Now the business is more diversified and it's all important, but it's just interesting even when they're very much focused on, all right, tell me more about that product that turns around in 48 hours because I need to know that I can scale this quickly over a period of time. So, and create more of it.
Yeah, and it's well, even for our own business, doing that kind of lending, it's quick turnaround for us, less time, similar amounts of money. Asset finance, quicker turnaround, less time, similar amounts of money. There's pros and cons with both, but yeah, it's triggering for us what you're saying too, because I think about our wealth business, and if we're looking at who you would assume profitable clients are, you would assume high net wealth clients that are going to pay more fees. But you could ask any of our advisors, and the first thing they'd say is, give me a mum and dad client over a high net wealth client any day of the week, because what the high net wealth client is willing to pay versus what they expect from a service proposition point of view generally don't line up. Whereas the mum and dad's happy to pay for the right value and don't create too much noise for us. So
appreciate it too. It's
value what you do,
and it does impact staff. He mentioned that as well. So if you can get that streamlined effect and find that sweet spot, it means you can do more and more of it, and you can evolve a business a lot quicker. So really time leverage as per profit per hour. So something to think about as business owners. Again, different perspective to what I had, but think about is potentially some of your best clients draining your revenues, and what can you do about it? Lesson number 2, build a valuable business, not just a profitable one. Now, I've always been very much on the metrics of profit and EBIT and everything else and margin, but this was a little bit deeper when I got the explanation, because they said there's a business that is profitable. The businesses that are profitable are not always valuable, but valuable businesses are always profitable. And I sort of said, look, explain a little bit more to me. This is very interesting. And he said, look, there's a stat that'll blow your mind. Over a business owner that holds a business for over 5 years, they tend to hold 60 to 70% of their net worth, their personal net worth in the business. And this is going on 2 different tangents, so bear with me. Yet only 8 to 10% of those businesses actually sell successfully when they go to market. So let that sort of sink in for a moment. So think about it from an investor point of view. He's thinking about, all right, I need to get a return in 5 years when I'm investing. And he said the 2 main reasons people want to sell a business, they want to, so it's a desire. So they optimize it and they're excited to sell it. The other one is they have to. And he said not a lot of people think about the have to circumstance. It might be due to health issues, life circumstances, might be business events, market shift, black swan events that are unexpected. So he's basically saying if you're not building a business that's valuable on all metrics, regardless of where you're at, you could be in a danger zone and you could be picked off. So, and he said value is also about, and I'll go into this in the next lesson as well, a lot more than what we're thinking just on the basic metrics, but it's really risky for business owners to have all that net wealth locked up in the business. And they're saying, if you love the business for what it is and you want to continue it, then absolutely go for it. But make sure you're talking to a financial planner or an advisor to build wealth outside of the business. So it might be an investment property, optimizing super at another level. There are cash flows available where you must build personal wealth if your plan is that you're happy to run a good business, have good cash flows. And he said it's like when people don't address this properly, it's like getting rent from an investment property but not owning the investment property. So it's like, he goes, that's the way I want founders to think about it. And if you're going to do that, make sure that you're building an investment property elsewhere personally. So because he goes, the percentages are not really in your favor. So you have to be able to play the trends to your advantage when you're talking to investors and making sure the key numbers are matching. And then we'll go into the next phase on how you can optimize that.
I think, I'll think back to a previous episode. To create that wealth, you need to have the ability to pull the money out of the business too, right?
Yeah.
So it's actually a really good reason to sit down and go, is this worth it? Because if you're building it just for the sake that it might be worth something one day, for me, that there's a lot of risks there. It needs to be a business that has a combination of, okay, this is an asset that's worth something, and second to that, this is an asset that can provide a reasonable income for me that allows me to feed my family and at the same time invest and build wealth. Now, some people might hear that and go, well, no, I'm balls and all into my business and I'm growing it. Well, that's great for some businesses, but for some businesses, if they're just a small to medium-sized enterprise, they're not trying to achieve a massive valuation. They're hoping their business will be worth something one day and they can get something for it. But most people are in it to create an income stream and create wealth. So, yeah, that's a really good reason to sit down and say, well, what do I need as an individual, and can this business actually...
And Nick, something you did really well that I found was very helpful is you would put a value on the business each month based on a level of metrics. So every shareholder within the business could see that value growing. So not only was there, the revenues that were earned, but you could see the value of that business month to month. And I thought that a lot of business owners don't understand the strength of that. They should be doing that for themselves, even if they're a smaller business. That's a really good way to go. Okay, I am growing my asset as well as drawing revenues from the business as well. I think that's powerful.
Yeah,
It's a bigger conversation that we're having now. We've probably done more, call it appraisals, they're mini business valuations, but we've done more than probably ever in the last month or two. And there's a few different reasons around. Some of it's around transferring shares from an individual to a family trust, and we need a value that we can fall back on to do it all above board and legal, keep ASIC and ATO and everyone happy. But sometimes it's also, we've got some trigger events where people are trying to buy out other shareholders and they want something to fall back on and say, hey, I don't actually know what my business is worth. Like the shareholder wants to exit. How do I give them a fair offer? How do I buy them out? And what are the steps? And it drives a really good conversation to go, cool, you might be running a profitable business, but if the founders walked away, is there something there to sell? Or is who's going to stay on? Have you built something? Jason Cunningham's an accountant at the practice, and he has a book called Have Your Cake and Sell It Too. And it goes through the steps of how to build a business that can operate without you and have value. So it's a combination of profitable and saleable. So if you have a lens of when you view your business, could I sell this business? Is it a saleable asset? And try and do a combination of both. I think it's a great approach.
The one thing I really liked about this investor is that he actually cared about the founder. So he had invested money into a business, but actually cared about the founder, that they needed to build their personal wealth as well. So the guidance was not only in the business, but how he had built personal wealth personally, having run a business previously. So I thought that was a great attribute. The other thing I found that was a little bit interesting within that premise. He said, we're all about looking at what the culture looks like longer term, even though sales metrics were more shorter term, but like thinking about what we want from the business to do in the market and who we want to attract to the business as a culture over a 4 to 5 year period. I think we're much more immediate on that usually in the way we operate our businesses. I know I have been in the past, but yeah, just a longer term. And why I thought that was important is you tend to rush. You rush and sometimes force business in a direction because you want to do more quickly. But just the balanced approach he had in regards to setting the cultures right, that we were doing it evenly for the shorter term and longer term, so we weren't stepping on toes, burning out people. It was really, again, it was uniquely different to what I had seen in the past from my own experiences. So it was interesting. But lesson number 3, the biggest misconception about selling your business business owners have is that it's worth more than it is because they're emotionally attached to it and they put so much sweat and grind into the business. We've all been there. We've all been there. And this is why, you talk about, Jace, you need to have some, metric, foundational metric to value that business, that you're confident in your industry that's going to produce a certain result. Because every business owner that hasn't done that it's like owning your own home. You always think it's like an unrenovated home. You always still think it's worth more than it is, but someone's got to come in and paint the walls and re-stump the bloody thing, and you're not going to get top dollar. You're going to leave money on the table. So very, very similar. If your business is unrenovated and you've been in it for 20 years, you're thinking, or 30 years, or however long people retiring now, it can become a real it can become a real problem point if it becomes a necessity to sell and people haven't got time in the game. Because to optimize, sometimes you need 18 months to 2 years to really work on it to optimize. It's not just a quick fix. So that was evidence. And some of the lessons around it, if you want to get the maximum value for sale, you got to start with a plan and a goal in mind. Like, what does it look like? What's the timing around it? How much is it? What do we need to do? What do we need to invest in order to get it right, to get that return? Jace, would that be something people could come to you with?
Yep, 100%. Love talking about the bigger strategy side and the succession plan and what does it look like. And it's often a shock to a business owner when you say to them, what if we removed you from the business? Like, how would it run? What would it do? Would it still operate and survive? Or are you a key person of dependence? And that often can swing the value of the business dramatically. So having that goal in mind and that plan to go, what are the steps it's going to take? What do we need? A sales team, HR, IT, like who does all the doing if the business owner is not there?
You raise the exact point the investor said. The last thing I want is for the business owner to be driving the revenues directly to that business and being the major revenue driver. That's a thing that kills most investments into business. If you can be an ambassador, set up a fully authentic and driven team to be running the business, then again, that transference is much easier for that investor just to take on board and to invest in as well. So that's one of the major reasons businesses don't get a sale, is because the heavy reliance on the founder that's generating the heartbeat of revenues to the business. And very important. And that is I was chatting to an accountant this morning about this. He said it's one of the biggest psychological factors that stop business owners from getting ahead and from getting top dollar. They just can't release themselves. They can't make that transition. It's too big a jump. And we've said this before sometimes, Nick, like almost when you're the deal maker and you're doing the deals on the front line, even in mortgage broking, and even if you're looking after then a team and you're sort of taking that next step back, you almost got to see, the broker as your deal. You've got to find some psychological. You've even removed yourself to the next station as more the ambassador and manager of the overall business. So it's vitally important to do that, but not many do. Not many without support in guiding them through. Soon as there's a little bit of a restriction on cash flow because they're not driving it, the default is straight back into comfort and I'll keep doing what I do again until I get frustrated, burnt out, don't want to do it anymore. And then it becomes a problem all up. But yeah, that was a big one. The other one was show strong upward trends of financials prior to selling. So make sure it's trending up and make sure you're leaving something on the table. Everyone wants to exhaust the top dollar. So they're saying, but it's like trying to hit the top of the stock market with a stock, right? You're never gonna get it right. But they're saying what you want to do is the upward trend and leave a little bit of skin in the game for more momentum as well, because there's a win-win-win, and it sort of guarantees that or more of a guarantee that you're going to get the lock-in on a strong price. Sometimes people go for that extended price and then miss the opportunity that was there. It's like you say, same again on properties. Like sometimes you get that great first offer and you go, no, there's 20 grand more in it. And you go, oh, we haven't had another offer. And it's the same mechanism. So again, human psychology, but they're saying sometimes it's important to take the win, but leave a little bit more skin in the game. And accountant, it was funny talking to the accountant, Jace, because I'm going, if you can buy an accountancy practice at 1 time's earnings, that's the general norm.
Mm-hmm.
I said, well, why aren't you looking at profit margin and things like that when you're buying a business, an accountancy business? And he goes, because generally you'll have the efficiencies already inbuilt in your own business, so you're buying revenue. But he said you still look for a factor of around about 20 to 30% profitability. So it's like that generally still happens, particularly if there's smaller businesses being gobbled up with less expenses. So I thought, that was interesting, even in your industry.
Because you strip out wherever they were renting can go, whatever subscriptions they were paying can bolt onto your already paid for subscriptions. Maybe there's an double up in admin. You might have enough admin capacity to take it on. So all of a sudden, it's not so much about what was happening on the bottom line, because if you can bring in additional 500K of revenue, if you've got strong systems and processes and good production, good people, you can turn that 500K into ongoing margin and net profit.
Yeah. So every industry has its niches, little nuances as well, which is really interesting. And the other one was build strong systems, team autonomy, and repeatable operations. So again, if someone's going to come in and invest, particularly, it's not always someone with industry experience that's coming in that's actually keen to make a good investment and wants to overview the operations. Very, very valuable. You're actually enhancing your scope of sale by having those type of investors look at your opportunity, as well as industry investors and business owners as well. So really important. They don't want to have to reinvent the wheel. If the wheel's spinning well and they can drive it harder, that's very, very exciting. So, and again, Nick will love this, but build a business that you don't want to sell because it's that good. It's generating profitability and it's building in value. So again, investors get very keen on those type of businesses, and generally you're going to get a higher price when you're in that position. So be in that position regardless. Better for you in real time, and better opportunities, and sometimes they come out of left field as well. So it's very powerful. And the final lesson was, and we've done this before, Nick, in regards to the strategy on a page, but the key objective for the quarter. What is the key objective, and what are the 4 strategic strategy actions that you're going to do to reach the key objective for the quarter? They're saying business owners get so distracted. They get bored and they will go off and want to do other interesting ventures, or we need to add this, we need to do that, but yet they're not meeting the key objective that actually makes the business valuable. So an investors, when they're on the advisory board, they say the main thing they're focusing on is to ensure that the key strategies are met and executed on and focused on to meet the key objective, to build the value of that company, build the culture of that company, build the qualities around the customer in that company, and to execute. Do more of what works and not more work on what doesn't. And that's an efficiency thing too. What's most efficient to getting you, and as I said, remember, building a valuable business isn't just about cashing out. It's about freedom, leverage, building wealth that lasts well beyond your involvement as well. So if you can get to that point, people are genuinely interested. So yeah, again, just some points. We've heard some of it before, but sometimes it's just pitched in a uniquely different way, and you pick up a couple of little subtleties there that can be helpful to business owners, or good business practice anyway.
Yeah. And Marty, it's a really good mindset. I mean, you might not be interested in your selling your business at all. You may not be interested in an investor coming in at all. But what about the mindset to go, if an investor was going to offer me money, how can I make sure my business was worth something? If I was going to sell tomorrow, or if I had to sell tomorrow, as you said, because of health or some other kind of thing that went, forced your hand, would I get what I deserve for my business because of how it's operating today?
Which happens.
So
more so I'm recognizing than, lucky I'm fit and virile at 53, but like a lot of people have misfortune, whether it's even terrible situations with kids and stuff like that, real serious stuff, wives, spouses. It's, things can change pretty dramatically. So you want to make sure that you're in, and like he said, build a business worth owning and selling, but worth owning, And
if it's worth owning or worth selling, that means it's performing for you
Correct.
anyway, and it's delivering what it needs to for you.
Correct.
Unbelievable.
Marty.
Great lessons, and always the fun, Marty, you should get out on the road more often. I think it's getting you to think of some great things to share with our audience. So thank you for listening. Thank you for tuning in, Marty. Thank you for your beautiful brain and great ideas. Until next time,
Stay focused, keep building. Game over.
this podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.